Certainly about the Fed's rate path, driving yields to their highest level in a month. For more on what's been happening, let's bring in Mark Cabana, head of U.S. rate strategy at Bank of America Securities. And it's kind of interesting, Mark. There's a lot of factors right now. Auctions, that should be the bottom line, is whether we can sell this stuff at certain yields. That's what I guess we would really, that's where the rubber meets the road a lot of the time. But then we get economic numbers and we get inflation numbers. So it looks like we're slowing a little, like GDP is not supposed to be rip-roaring. That seems like you could get a rate cut from that, but not until we're sure that inflation has resumed a downward trajectory.
Yes. So over the last week, we've seen U.S. rates back up by about 15 basis points at the 10-year. Since the middle of May, we've seen rates back up about 25 basis points. And we think that this is due to a combination of factors. It's due to some better than expected recent economic data, including consumer confidence. It's due to flows and positioning, where we've seen asset managers get quite long and then have limited capacity to lean against the rate move. And it's also due to some of those underwhelming auctions that we had recently. This week, we had 2, 5, and 7-year auctions. They all had pretty low bid cover ratios, and they also came at slightly higher rates than what the market was previously anticipating going into those auctions. So all of those factors, we think, have contributed to rates moving higher. And the market's really asking itself now, what's the next move from here? Our forecasts have rates going down slightly through the end of the year, and that is due to what we think will be a slight moderation in U.S. economic activity, inflation that comes back down, and a labor market that moves into better balance. But the path to get there is probably going to be somewhat bumpy.
Mark, what if just the first thing happened that you said, and the economy slows a little bit, but inflation stays sticky, that last mile? What if that's much harder than we thought? Can the Fed assume that there will be a lag and that a slowing economy will eventually bring inflation down, or can we not assume that? I don't know whether, I'm worried about stagflation. We could have both. We could have the worst of both.
Sure. Yeah. And I think that's a fair concern for many in the market to have. What the Fed has told us is that they need more confidence that inflation will be moving sustainably lower over time. And we think that the single most important factor to give them that confidence is going to be moderation in growth and a rebalancing in the labor market, such that the pace of job growth slows down to something that they think is more sustainable, probably between 100 to 150,000 payroll growth per month. And then they're going to have confidence that wage growth is going to decelerate with that. And as long as that happens, then the Fed probably will believe that it's going to be successful in its last mile against inflation. But if it doesn't see that demand destruction, then it's not going to have that confidence, and it's going to need to keep rates higher for longer.
With what we've seen in commodities, Mark, I just wonder whether a super spike in oil, and I don't know what would cause it, just, fill in the blanks on what could cause a super spike in oil. But you could even have maybe a labor market rebalancing and all the things that you said. But if you don't get a you could have the inflation coming from something else totally unrelated to that.
Absolutely. And that is a risk that the Fed always contends with. Certainly, there's a number of geopolitical flashpoints in the world today. There's a number of reasons to believe that if there's some type of miscalculation, you could indeed see commodity prices higher. And that not only matters for consumers and what's coming out of their pocket every month, but it also really matters for inflation expectations. And if the Fed sees inflation expectations that start to move higher in a meaningful way, they've been very stable of late. But if they start to see inflation expectations meaningfully move higher, then the Fed is going to feel pressured to not just keep rates higher for longer, but maybe indeed start to hike rates again. And that, we think, is arguably the biggest risk for markets broadly. If the Fed were to start hiking again, it's not our base case, but it is a risk. Then we do think that would likely lead to a tightening of financial conditions broadly. And we suspect that the equity market would not necessarily view that too favorably.
We will not have a recession in 2024. Is that 100%?
It seems very unlikely right now. You never want to say 100% probability of one thing and 0% probability of another, because the economy can evolve in very unexpected ways. But based upon the activity data that we have in hand right now, it certainly does not look like we're going to see a recession. And the issue that the Fed and broader rates markets are grappling with is the fact that demand has been too strong, not too weak. And that elevated demand is putting upward pressure on prices. And that is indeed the issue that the Fed is having to contend with today.
Right. A lot of stuff still, a lot of liquidity still around, a lot of both fiscal, monetary, everything else. But you know, what's GDP going to, what for the last 6 months of the year, what do you expect GDP to run? Where will that run? 1%,
yeah, we expect a real
change.
We expect the real GDP growth, at least our economists do, will be right around 2% in real terms.
Okay.
And that's elevated in relation to
right.
certainly pre-COVID. It's elevated in relation to trend, where we think it's going to settle over the longer run.